I thought we could do or start with a little laugh after this first week of lectures, all online. But hopefully we're settling soon or have settled. In lecture 1 and 2, I discussed the accounting cycle, transactions, source documents, journals, ledgers, reconciliations, and we got to the end of the month, and at the end of the month a trial balance is drawn up. So where we're going is to the explanation of what a trial balance is. A trial balance is done at the end of the month. So let's have a look at a trial balance. Just before we get to the trial balance, it was great to have a few students that made it to class last week. But no problem if you weren't there. We will catch up everything when it's a bit safer to be on campus. We had a little bit of fun and just to play around with the photo. So things are good. I look forward to seeing you all soon. So what is the definition of a trial balance? A trial balance is a report that lists all the general ledger accounts of a business with their debit or credit balances to check whether total debits equal total credits. And what that means is the following. I will show you a picture of a trial balance. So in the trial balance, it's drawn up at the end of the month. There's a space for debit balances and a space for credit balances. So there's a column for debit balance and a column for credit balances. These balances will end up either on the debit or credit side according to accounting rules. More about that later. So here we got the capital account, statement of financial position, we got owner's equity, we got assets, and we've got liabilities. So the owner is equal to the value of the assets minus the value of the liabilities. And if we swap that around to get the accounting equation, A is equal to O plus L. But this here is a trial balance. We can see what is the bank balance supposed to be at the 28th of February, 150,622. Now this section here is the statement of financial position section of the trial balance. In the previous slide, I showed you the statement of financial position section of a trial balance. Now, in the same trial balance, there will be the nominal accounts section. We will look at the income accounts and the expense accounts. Remember, income minus expenses is equal to profit if your income is greater than your expenses. If your expenses are greater than your income, you will end up with a loss. Right, so this is the nominal accounts section of the trial balance. And once again, all these accounts have debit and credit balances. You can see income, they have credit balances. All your expenses have debit balances, because the accounting rules will result in whether an account is debited or credited. Right, the International Financial Reporting Standards, they have put in place qualitative characteristics to make sure we're heading towards financial statements, and the IFRS, the world, shall we call it the world governing body of accounting, have put qualitative characteristics in place to control the quality of financial records. There are fundamental qualitative characteristics saying that all information that is recorded in the books of a business or on the statements need to be relevant to the stakeholders, all those people making decisions, to management. So the information needs to be relevant, and all the information that is recorded needs to be honestly and accurately recorded, faithful representation. Now, these statements also have enhancing qualitative characteristics, and they are: the statement should be comparability, should have a qualitative characteristic named comparability, which means the statements should be able to be compared to statements of other businesses and to statements from previous years. So basically, you need to abide by accounting principles, because if everyone is abiding by accounting principles and policies, then the books of different businesses in the same industry can be compared. You can also compare last year to this year and make informed decisions. If you've recorded the books in a way by being consistent with how you record the information, then the information can be compared, accurately compared, and that'll help you with making good decisions. Right, the statements should be easily read by stakeholders, easily understood. So the statements need to be clear. They need to be presented on time. Also, all the income and expenses, let's say for example, need to be recorded in the correct period that is being reported on. So all the information must be in the right period. Verifiability means if you took your books after you've completed your books to another bookkeeper or another accountant, that accountant should be able to verify the numbers by arriving at the same profit or loss or the same financial position of the business. So verifiability means if some other auditor took your books and did them, the same results should be calculated. So your books should be verifiable, should be verified, be able to be verified by another bookkeeper or accountant. So all these characteristics here, enforced by the International Financial Reporting Standards, will control the quality of the bookkeeping. So we all, as bookkeepers, follow policies and guidelines that are put in place by the International Financial Reporting Standard. It used to be GAAP, Generally Accepted Accounting Practice, but most countries are following the IFRS as to how they record financial information. So there's consistency across countries. So there's a little bit of information on the IFRS and qualitative characteristics that they have put in place. Now, having said that, we can look at financial statements which are governed by the IFRS. So we're following policy when we draw up these documents. Now, first of all, I've got a statement of profit and loss and other comprehensive income. In this statement, which is the income statement, it is now known as the statement of profit or loss and other comprehensive income. In here, we're going to have the income of the business less the expenses will either give a profit or a loss. And more about the statements in due course. We will draw up some statements towards the end of the year, but this is an income statement, and in the income statement you're going to have the nominal accounts of the trial balance, which are the income accounts and the expense accounts, and you're going to calculate the profit or loss. Then the profit or loss goes to the owner of the sole trader or sole proprietor and will get added to the owner's capital account. So this is an income statement. Right, then we have a statement of financial position. Now, after the income statement is drawn up, we then draw up a statement of financial position. When are these statements drawn up? They're drawn up at the end of the financial year, so after 12 months. The owner wants to see if the business has made a profit for the 12 months. Who's entitled to the profit? The owner. And also we want to see what the owner is worth, what the assets are, what the liabilities are. That information will be all in the statement of financial position. And after these statements are drawn up, some analysis and interpretation of the statements is done. So there is a statement of financial position. Now this will show you a number of things. It shows you the total assets, the total owner's equity, and the total liabilities. And I may have mentioned this before. Assets is equal to owner's equity plus liabilities. So the accounting equation, the statement and the accounting equation are basically the same, except you have drawn up this accounting equation in a standard format, the statement of financial position. And we look, the assets here are 470,000, and if you add the owner's equity plus the liabilities, you're going to get 470,000. So this statement of financial position, balance sheet, balances. From this document, a lot of analysis and interpretation can take place. There are also notes to the financial statements, but more about those later. And there's our accounting equation. Assets equals owner's equity plus liabilities. And then back to the accounting equation. So at the end of RFC 1011, we would have done transactions, the accounting equations, source documents, journals, some ledgers, a bank reconciliation, a trial balance. In the second part of the year, we will go on to adjustments and financial statements. So that's where we're going. I'm looking forward to working with you all, and that should take us to, this video will take us to the end of chapter 2. Cheers, bye. Oh yes, one more thing I left out. There's also a statement of changes in equity and a cash flow statement. Statement of changes in equity is simply DICE, capital, income, drawings, and expenses affect owner's equity. So that will be shown the profit. Who's entitled to the profit? The owner. So capital plus the profit less drawings will give you owner's equity. Right, there's still actually more notes. I thought I was finished. But forms of ownership, we're going to be looking at a sole trader. And there we have our case study, Calibre Education. It's a sole trader. If we look at the advantages and disadvantages, easy to set up. A sole trader is not costly. Owners make the decisions. Not many legalities. Not much capital is needed. It's a small business, a sole trader normally. Less tax if you're not making big profits. And advantage, who's entitled to the profits? The owner. Now, a disadvantage of a form of ownership, unlimited liability. So what that means is your personal possessions as the owner can be attached to the debts of the sole trader, the sole proprietor, to your business. So if you can't pay your liabilities, your current liabilities, you might have to sell your personal car or house, personal possessions, in order to pay your business debt. So that is called unlimited liability. It might be difficult to raise capital, being a one-man show. Your income is taxed at the owner's personal rate, so they'll take the profit of the business and all the income in your personal capacity, add it together, and you could move into a higher tax bracket. So that's a disadvantage. Also, if you're a sole trader and you want your business to perform, you might need to be in the shop all the time to make sure that staff are managing the shop and working properly. And also you have the passion for the business, so you're going to find yourself maybe 24/7 involved in your business. Accounts payable is a general ledger account that summarizes all your credit purchases. So when you've bought from creditors or suppliers, and you've bought on credit, you get the goods now and you pay later. Accounts payable is a summary of all the individual creditors. So if you bought from supplier A, B, and C, you owe A 2,000 Rand, you owe B 1,000 Rand, you owe C 500 Rand. The balance of accounts payable, which summarizes all these individual creditors, should be, in this case, 3,500. By the way, these individual creditors, the accounts are held individually in the accounts payable ledger or creditors ledger. But accounts payable is a summary of all your individual creditors. So accounts payable is the amount a business owes to suppliers for goods or services received but not yet paid for. So for goods or services bought on credit. This here is an example of an accounts payable account in the general ledger. Now, accounts payable can also be known as creditors control. Some textbooks might use different terminology, but I'll tell you quickly, whether you call this creditors control or accounts payable, you can pick up the name of an account normally through a trial balance. The balance is in the trial balance, what the business is calling the account. But whether it's creditors control or accounts payable, the category for this account is a current liability. That L stands for liability. For this month, just quickly, we'll do general ledger accounts in a month or so. But we bought on credit, Calibre Education, 89,320 Rand worth of goods and services. There were discount was given for prompt settlement. There were returns, and we made payments. And the balance, interesting, at the end of February, March the 1st, according to our books, we owed our creditors 0. You will do a creditors reconciliation also later in this course. But accounts payable, it's a general ledger account which summarizes all your individual creditors. On the other hand, accounts receivable records all the credit sales we have made to individual debtors. Another name for this account is debtors control. So accounts receivable is the amount a business is owed by its customers for goods or services delivered. We delivered these goods or services, but we haven't been paid for them. Yet. So credit sales, we've delivered the goods, but we haven't been paid. So the debtors control will keep a record. Accounts receivable will keep a record of credit sales to customers. So those customers that have an account with us, their details will be summarized in the accounts receivable account, what is owed to us. So a general ledger account will look like this. I'm using the name debtors control. Quite often the name accounts receivable is used, but it doesn't matter once again what the name is. You can pick up the name the business is using by looking at the software or the trial balance. Accounts receivable, debtors control, same thing. The account is a current asset. People we've sold to on credit, they're recorded as a current asset. More about the details of this account at a later stage. You just need to know the definition of accounts receivable. What does a business entity mean? A business entity is an independent economic unit whose financial activities are recorded separately from that of its owner's personal affairs. So there is a rule, the business entity rule, which states that if this is our business, Calibre Education, this is the owner of Calibre Education's house, and if the owner of Calibre Education buys food to consume in his or her personal capacity, that transaction is recorded separately to that of the business. So there's the business entity rule, business entity principle, the transactions of the owner, the personal transactions of the owner are recorded separately to that of the business. But a business entity, once again, is an independent economic unit, an independent business whose financial activities are recorded separately from its owner's personal affairs. Right, what is a creditor? A creditor is a person or business to whom the company owes money for goods or services received on credit. For example, Calibu Education buys from the computer store on credit. So Calibu gets products delivered from the computer store, the supplier. The goods are delivered, but Calibu pays the supplier at a later date. And this supplier here is an example of a creditor. Buy now, pay later. So it's goods we've bought on credit. In the books of Calibu, the computer store is a creditor. By the way, a creditor to the business is a current liability. What is the financial period and the financial year? The financial period is the 12 months the business is reporting on, same as financial year. So for a 12-month period, it can be from the 1st of January to the 31st of December. It's 12 consecutive months that we're looking at. That's a financial period or a financial year. Right, what is a debtor? A debtor is a person or business that owes money to our business because we have sold to them on credit. For example, Calibu Education sells to a client of theirs, the school, on credit. So if Calibu Education sells, for example, tablets to the school gets the tablets and pays for them at a later date. So the school is called a debtor of Calibu Education. And a debtor is a current asset. The accounting equation. Every single transaction that takes place in the business will have an effect on the accounting equation. So the accounting equation is the fundamental rule of double entry, stating that the value of the business's assets equals its liabilities plus owner's equity. So A is equal to O plus L. Now, how is that accounting equation derived? I'll start with, what is an owner worth? Owner's equity is equal to the value of the assets of the business less the total liabilities, the value of the liabilities. So what the owner or the business owns less what the business owes. So owner's equity is equal to assets minus liabilities. Now, if I change the subject of the formula, I do a little bit of maths here. So at the moment, owner's equity is the subject of the formula. You know a little bit of maths. And I take the liabilities to the left-hand side. The sign will change from a minus to a plus. So we got owner's equity plus liabilities is equal to assets. Now if I take the assets and I put it on the left hand side, and I swap the left hand side and I put it on the right side, I'm going to get the accounting equation. Assets equals owner's equity plus liabilities. So I started looking at what the owner is worth. The owner is worth the value of his assets less the value of the liabilities, the total liabilities. And if I make assets, the value of the assets, the subject of the formula, you're going to get assets is equal to owner's equity plus liabilities, and that is the accounting equation. And just for a little bit of fun, I brought it in on a paper plane. Let me rub out a little bit here so you can see clearly. We're going to work with this the whole year. Accountants work with this forever. This is actually the layout of the statement of financial position. Assets is equal to owner's equity plus liabilities. A equals O plus L. Don't ever forget that. Right, what does the term liquid mean? When people say a company is liquid, they mean it has enough cash readily available to pay its short-term debts, short-term liabilities. So current assets are greater than current liabilities. They mean it has enough cash or easily convertible assets, current assets greater than current liabilities. The business is said to be liquid. So if you went into liquidation on a regular basis, the liabilities, current liabilities, would be greater than the current assets. So there needs to be enough cash or assets that are quickly converted into cash, and the cash needs to be greater than the current liabilities. This is our supplier, the computer store, which is a current liability. Current assets must be greater than current liabilities for the business to be in a liquid position. So what does solvent mean? Now solvent, a business is solvent if the total assets exceed the total liabilities. So the total assets are greater than the total liabilities. And we are including here non-current assets and current assets, and non-current liabilities and current liabilities. So our assets, including current and non-current, are greater than our total liabilities. Long-term loan, non-current liability, and current liability, our supplier. So the total asset value is greater than the total liabilities. Right, this brings us on to a statement of profit or loss. Now, a statement of profit or loss and other comprehensive income, you might know as an income statement. And in this document we will get to at the end of the year, you're going to have all your income and expenses. Income minus expenses will be a profit if the income is greater than the expenses. If the income is less than the expenses, you are going to make a loss. So here we got a statement of profit or loss and other comprehensive income. That's an income statement, and this is drawn up for your financial year. At the end of the financial year, you calculate whether you made a profit or a loss in a formal document, statement of profit or loss. In this document, income, and expenses. And then we have a statement of financial position. So what will happen is, included in the owner's equity will be the profit from the income statement, and in this document you're going to have assets, this is magic, is equal to owner's equity, that's an O, plus liabilities, and that is your accounting equation. And in this document is summarized all the transactions for the year will end up in this document, and this document will tell you once you analyze and interpret the numbers on here, the position of the business at the end of the financial year. Accounting is fun, especially if your statement of financial position balances 470,000, 470,000. So if you've kept accurate records throughout the year, your statement of financial position or balance sheet will balance. Soon we're going to get on to the accounting equation and how transactions affect the accounting equation. That's the next chapter. We will chat soon. Cheers. Bye.